Good morning. I'd like to welcome everyone to the Arlington Asset Fourth Quarter 2020 earnings call. Please be aware that each of your lines is in a listen-only mode. After the company's remarks, we will open the floor for questions. If you would like to ask a question, please press star followed by 1 on your telephone keypad. If you would like to remove yourself from the questioning queue, press star 2. I would now like to turn the conference over to Richard Konsman. Mr. Konsman, you may begin.
Thank you very much and good morning. This is Rich Konsman, Chief Financial Officer of Arlington Asset. Before we begin this morning's call, I would like to remind everyone that statements concerning future financial or business performance, market conditions, business strategies or expectations, and any other guidance on present or future periods constitute forward-looking statements that are subject to a number of factors, risks, and uncertainties that might cause actual results to differ materially from the stated expectations or current circumstances. These forward-looking statements are based on management's beliefs, assumptions, and expectations, which are subject to change, risk, and uncertainty as a result of possible events or factors. These and other material risks are described in the company's annual report on Form 10-K and other documents filed by the company with the SEC from time to time, which are available from the company and from the SEC, and you should read and understand these risks when evaluating any forward-looking statement. I would now like to turn the call over to Rock Consul for his remarks.
Thank you, Rich. Good morning and welcome to the fourth quarter 2020 earnings call for Arlington Asset. Also joining me on the call today is John Murray, our portfolio manager. During the fourth quarter, optimism for both additional fiscal stimulus and a successful vaccine rollout, along with continued monetary support, led to a market expectation of a pending economic recovery. Risk asset prices extended their rally from last quarter, with equity markets continuing to strengthen and credit spreads on most fixed income asset classes tightening, while the yield curve steepened and long-term interest rates rose in response to the improved economic outlook. With low interest rate volatility and ongoing Federal Reserve balance sheet support, agency mortgages performed well during the fourth quarter, with repo funding for agency MBS readily available at attractive funding costs. However, there's elevated investment risk in agency mortgages that trade at historically high premiums to par and are dependent on ongoing purchases of agency mortgages by the Federal Reserve, combined with an uncertain path of prepayments in a low-rate environment. Mortgage credit asset values also generally increased during the fourth quarter, reflecting overall tightening of credit spreads and a positive sentiment towards risk assets. Residential mortgage credit assets continue to be supported by strong home price appreciation and low mortgage rates. Overall, the general theme of an improved economic outlook led to a strengthening of values across financial assets, with spread tightening reducing the expected return profile of new investments going forward. However, the company believes that there are investment opportunities available at this time in this environment that can deliver attractive returns to shareholders over time. The company's goal is to build an investment portfolio with multiple sources of income which complement our agency MBS portfolio, diversify risk, and improve the level and reliability of returns. The company expects to complement its allocation of capital in agency mortgages by redeploying portions of its liquidity, currently in the form of unencumbered agency MBS, into its other targeted investment strategies, including mortgage servicing rights, mortgage credit, and other financial asset classes. We expect to maintain a strong, stable, and liquid financial position by keeping leverage low and financial flexibility high, while utilizing term, non-margin financing structures where available. In addition, the company is focused on creating partnerships or platforms where possible to promote the predictability of investment flows, growth, and the potential for compounding value creation opportunities that layer on top of the current investment returns embedded in the company's investments. Before discussing the results for the quarter in more detail, I'd like to note a few highlights. The company produced approximately a 7% economic return while maintaining complete financial flexibility, low leverage, and a strong, secure, and stable balance sheet structure. We established high return investment channels in mortgage servicing rights and completed initial investments in MSRs through a strategic relationship with a GSE servicer from which we currently expect unlevered double-digit return opportunities and the potential for appreciation as well as ongoing MSR opportunities. The company continued to repurchase shares of its common stock at accretive prices, ultimately repurchasing 10% of outstanding shares during the year, and the company improved its cost structure, leading to a reduction in G&A expenses by 16% for the year, with additional potential savings in 2021 that are expected to reduce expenses by approximately 25% over a 2-year period. For the fourth quarter, the company reported net income of 32 cents per share and core operating income of 12 cents per share. The company's core operating income benefited from its investment in a consolidated trust of business purpose residential mortgage loans, which contributed approximately 8 cents per share of core operating income during the fourth quarter. Going forward, notwithstanding the expected continued strong economic performance of this particular investment, the company expects that its contribution to the company's core operating income will be lower in the first 2 quarters of 21, as its short duration of this asset is expected to lead to an accelerated paydown of the investment during the first half of the year. The company's book value was $6.31 per share as of December 31st, as both its agency MBS and mortgage credit investment strategies experienced positive performance. This resulted in the company delivering an approximate 7% economic return during the fourth quarter while still maintaining a conservative risk profile and low leverage. As of December 31st, the company's overall at-risk leverage ratio was 2.4 to 1, with the company having significant financial flexibility. The company continues to be committed to its stock repurchase program. During the fourth quarter, the company repurchased 1.5% of its outstanding common stock at an average repurchase price of $2.83 per share. That contributed 5 cents per share to book value. For the year, the company repurchased 10% of its outstanding common stock that accreted 29 cents per share to book value. As of December 31st, the company had remaining board authorization to repurchase up to 16.2 million shares of common stock. The company was pleased with the performance of both its agency MBS and mortgage credit investment portfolios during the fourth quarter, as both positions benefited from spread tightening. As of December 31st, the company's investable capital was allocated 81% to its agency mortgage strategy, 16% to mortgage credit, and 3% to MSRs. Since January 1st, we have allocated an additional $7 million to our mortgage servicing rights strategy, which raises the overall MSR allocation to 5% of capital, and we expect that to continue to increase. Levered agency MBS returns continue to benefit from low repo funding costs, ongoing Federal Reserve support, as well as a steepening yield curve. Against this backdrop, we are currently seeing available returns in the high single digits in levered agency MBS with an appropriate hedge position. However, the company remains somewhat cautious about significantly increasing leverage on its allocated agency mortgage capital in the current environment. As a result of the Federal Reserve's present support of the agency mortgage market through large-scale purchases, agency bond prices are relatively expensive, trading at a significant premium to par, including sizable pay-up premiums for specified mortgage pools. If the economy continues to demonstrate improvement, any market expectation that the Federal Reserve could taper its holding of agency mortgages could lead to a meaningful widening of agency mortgage spreads, which, on the other hand, would provide an attractive entry point for new investments. In the current environment, the company expects to maintain a substantial capital allocation to agency MBS while evaluating opportunities to redeploy liquidity it holds, primarily in the form of unencumbered agency MBS, into other investments in its target strategies that complement agency MBS, while offering at the same time better risk-adjusted returns and requiring lower at-risk leverage. The company is presently focused on particular on growing its investments in MSR-related assets, as well as business purpose and other residential mortgage loans, while also closely reviewing other opportunities such as single-family rental and specialty finance assets that meet the company's objectives for low leverage, strong returns, diversification of risk, and term or non-marginable financing structures. The company continues to see compelling return opportunities in newly created mortgage servicing rights of Fannie Mae and Freddie Mac loans. At current purchase price multiples, just above 3 times, unlevered MSR investments provide superior base returns to levered agency MBS with potential upside from multiple expansion, without mark-to-market financing risk, and reduced exposure to matched hedge funding risk. In addition, our investment in MSRs diversifies our investment risk, as mortgage servicing rights generally have a negative return correlation to most of the other investment classes the company owns or is evaluating, including agency MBS. We also benefit from our long-term institutional knowledge in assessing prepayment risk in agency mortgages when evaluating MSR investment opportunities. However, significant barriers to entry exist for investing in the mortgage servicing rights arena, as one is required to hold specific licenses to purchase or hold MSRs directly. To invest in MSRs through traditional means, an investor would typically need to establish or acquire a licensed residential mortgage servicer, which requires a significant amount of time and capital to complete, as well as subjects the investor to ongoing operational and regulatory oversight and risk. As an alternative to the traditional pathway, the company has entered into a strategic partnership with a licensed GSE-approved servicer during the fourth quarter that enables the company to garner the economic return of an investment in MSRs without the company holding the requisite licenses directly. At a high level, the company is effectively renting instead of purchasing a licensed servicing platform. We believe our strategic relationship is the most efficient and cost-effective way for Arlington to gain exposure to mortgage servicing rights. Under the terms of our strategic relationship, the company provides capital to our partner to purchase an MSR directly, and the company, in turn, receives all the economics of the MSR, less a fee payable to our partner. At our option and direction, our strategic partner has the capacity to utilize leverage to potentially increase returns to us. We completed our first MSR transaction at the end of December with an additional investment in early 2021 for a total current investment of $16 million, comprised entirely of newly originated Fannie Mae loans. These MSRs were purchased at an average multiple of 3.1 times, with an expected unlevered return of approximately 10%, while also offering potential appreciation with any retracement toward pre-COVID MSR multiples. As of December 31st, the company did not have outstanding repo on any of its non-agency MBS. The company's sole repo funding exposure on its mortgage credit investment portfolio consists of a $32 million repo funding for a commercial mortgage loan with strong credit characteristics that has performed in line with expectations at its origination. This repo facility matures in November of 2021 and has not experienced any margin calls to date. Going forward, the company will continue to limit its use of marginable repo funding for mortgage credit investments. Instead, the company will focus on financing mortgage credit investments either directly or indirectly through longer-term and non-marginable financing structures where possible. The company has also made significant progress towards improving its cost structure. For the year, the company lowered G&A expenses by 16% from the year earlier. Further, some of the expense reduction initiatives already taken by the company will not be fully realized until the end of 21. The company expects that by the end of 2021, it will have lowered its annual run rate of G&A expenses by over $3.5 million, or almost 25% over a 2-year period. Overall, during the fourth quarter, the company made solid progress toward its objective to complement its core agency MBS portfolio by building a series of high-return, non-commodity investment channels which provide multiple sources of income to raise overall returns to shareholders, diversify risk, and offer sustainable ongoing investment flows as well as potential asset and platform upside. In addition to its existing MBS, agency MBS, MSR, and mortgage credit strategies, the company continues to evaluate other attractive specialty finance investment opportunities with a focus on developing investment platforms and partnerships that could potentially result in longer-term enterprise value creation. As the company deploys available capital to agency MBS and our diversified investments made through non-commodity channels, we expect higher returns from these investments to provide expanded earnings power over time, which can form the pathway potentially for returning capital to shareholders. As that deployment process occurs, we expect to maintain a strong financial position highlighted by low leverage, high financial flexibility, and the use of term financing structures where possible, enabling the company to be opportunistic and capture attractive investment opportunities that may arise across sectors as conditions evolve, as well as the ongoing ability to utilize its sizable stock repurchase authority. Thank you very much, and we're happy to take questions.
Thank you. At this time, we will open the floor for questions. If you would like to ask a question, please press star followed by 1 on your telephone keypad. Questions will be taken in the order in which they are received. If at any time you would like to remove yourself from the questioning queue, press star 2. Our first question comes from Doug Harter with Credit Suisse. Please go ahead.
Thanks. Brock, hoping you could tell us a little bit more about who you're partnered with on the MSRs, and just any sense of how we should think about whether you're taking any counterparty risk in the way that you have that MSR ownership structured.
No, we're invested with an existing servicer that's had a fairly lengthy history in the business, and we don't have any particular counterparty risk in it. Our recourse, the recourse is to the investment itself. We receive the returns. Valuations in that asset can fluctuate up or down, of course, although we think these multiples are attractive, and we feel like we've got a reliable partner, and coincidentally, it's got some similar, characteristics, some other partnerships that have been announced in the market recently.
Great. And then I guess can you just talk about, is it kind of your discretion for future investments in MSRs that are made, and, how much of that is going to kind of be on a flow basis versus kind of bulk opportunities, just to think about the pacing of new opportunities?
It is at our election. There's a rather constant flow, Doug, as you would expect, of opportunities. But what we're seeing so far is a combination of flow and bulk opportunities. We've participated in both. So we will be able to be opportunistic in that and capture what we think are the best situations for risk return. And we control the lever on the pace and the specific investments through that channel. We do have the opportunity for increased exposure there over time, but it is at our election.
Great. I appreciate it. Thanks for the time today, Rock.
Thank you, Doug.
Our next question comes from Trevor Cranston with JMP Securities. Please go ahead.
Hey, thanks. Good morning.
Morning.
A couple more questions on the MSR strategy. I guess first one, how are you guys thinking about as you deploy more capital into MSR assets? Do you anticipate replacing some of your swap hedges on the agency book as the MSR piece grows, or how do you think about that as a hedge to the agency MBS strategy?
Well, to your point, Trevor, as you know, the MSRs are a natural hedge component for the agency portfolio. So over time, as the scale of that MSR silo grows and that allocation grows, then that will form more of a proportion of the hedge structure, and at a certain point would replace swaps, some amount of the swaps.
Okay, got it. And you mentioned that there's the ability to apply some leverage to the MSR asset in the future if you choose to. Does the partner you're working with on the strategy already have access to a financing line for MSRs, or is that something that you guys would need to get your own financing line?
It's in place. That facility is in place.
Okay, got it. And then one last thing on that. I mean, I think you mentioned there's an oversight fee associated with the strategy. Can you just talk about what the fees are that you're going to be paying to the partner?
It's a percentage. It's a percentage of the realized return over the life. So it'll be based on what our actual return experience is, and then it's a proportion of that is entirely reasonable and consistent with market standards.
Okay, great. And then just one thing on the credit portfolio. You mentioned the consolidated business purpose loans. Had a pretty big impact on 1Q results, but it's going to decline given the short duration of those assets. Are there any other opportunities you guys are currently seeing in the credit space that you think are attractive and you might look to sort of redeploy as the BPL assets pay down?
Well, I'd say as you surely have observed as well, Trevor, spreads generally are pretty tight. So we are intensely focused, as I'm sure other of your companies are, management teams, intensely focused on identifying those circumstances where one can generate a bit outsized returns. Those are harder and harder to achieve in CUSIP securities. So increasingly, direct loan-related opportunities we find have been demonstrating a bit better return profiles, but we do see occasionally interesting opportunities in the RPL space. We have also seen occasional opportunities in the BPL space. It's gotten more expensive, but we see occasionally opportunities there, and we expect to try to take advantage of those as well. And then, as I said, I think in the script, we are closely evaluating single-family rental, which does not mean it's certain that we deploy capital there, but we are very closely evaluating that, as that appears to have some attractive return profiles versus the risk parameters as well.
Got it. Okay. Appreciate the comments. Thank you.
Next, we will go to Jason Stewart with Jones Trading. Please go ahead.
Well, one more thing, just real quick before you go, Jason, in response to Trevor's question. One other area that we have examined that we find to be quite compelling are some solar residential related loans. And we've spent a good deal of time closely evaluating those, and we expect that there's a reasonable chance that over the course of 21 we may very well deploy capital there. Those, among many of the other opportunities we see, carry with them quite attractive returns.
I'll say
Sorry,
thank
Jason,
you for Trevor.
Go ahead.
That's okay. No, thanks. Along the same lines, Rock, when you're describing some of these strategies, they all seem sort of in line with remaining a REIT. But if you pull back up and look at the status of the company and really one of the larger assets in levered agency, maybe you could talk about the future of that, given your comments around the return profile, these other businesses, how you see the company structured longer term.
Well, as I said in the script, Jason, what we're seeking to accomplish is to complement that agency portfolio with to provide a level of diversification of risk and overall higher returns in an environment where agency prices are relatively expensive, although they're cheaper today than they were a week ago. but they're relatively expensive relative to the characteristics and the returns, and therefore, when we're envisioning high single digits returns there with meaningful leverage profile, we're seeking alternatives that can generate those or higher returns without that level of marginable risk profile, and provide for the opportunity to use term or structured finance elements to them. And so what we envision is that will be an ongoing dynamic process. Certainly in the near term, we would envision that the agency portfolio would form the bulk of that allocation, and it will take us time to deploy the capital into these other arenas. We've made a good level of progress with the deployment to BPLs and certain of our other mortgage credit investments over the back half of 20, which did exceptionally well. We continue to mine those silos for opportunity. We find them occasionally, although, as I said, they're fairly expensive. And the new ones, whether that is MSRs, which we find to be quite attractive relative to other asset classes right now, we expect to grow that and provide for and along with potentially single-family rental or maybe solar opportunities as they come to us. We will have a more balanced approach in which agencies, as a REIT, agencies will presumably comprise a substantial proportion of the capital allocation, but will have a balanced weighting in other elements that raise the overall return profile, at least during the period in which agency returns are at this level. If they were to cheapen up meaningfully, then that would allow us, through a dynamic process, to reallocate capital back to agencies if the returns, in very large scale, if the returns elevate to a level based on the price of the asset and any change that we may experience in CPR profiles and the shape of the curve. If those returns elevate enough, then we will be wide open to the idea of moving capital back in that direction in more scale. But our goal is to build non-commodity channels with higher returns that ideally have a platform capability which gives sustainable ongoing flows, and we may find those that provide us a franchise or platform upside opportunity. We are in the process of evaluating a couple of those right at the moment, which could be quite compelling. So we're making room for those kinds of opportunities and to complement the agency risk return profile.
Okay. And all these strategies have pretty strong cash flow components to it. So if you remain a REIT, and I would assume you have no distribution requirement for 2021, and you pull all this together, what's your big picture thought on when the dividend becomes more of a part of the conversation?
Well, as I said in the script, thanks, Jason. As I said in the script, I think we, the ongoing deployment of the available capital embedded in the existing agency portfolio can be reallocated to those. That process is underway. That will take some time. And as that deployment goes on, we would expect the earnings power of the company to elevate. And as that elevation occurs, then that will form the foundation for returning capital to shareholders in its various forms, including distributions through a dividend to the shareholders.
Okay. One more, and then I'll jump out. On the MSR, yes, sir.
No, I said please. Go ahead.
On the MSR, you gave us a lot of great detail. The return profile is a little bit higher than I think the typical market sees for MSRs today, and I assume that's because of the strategic benefit of the relationship. Could you talk through sort of what that relationship brings in terms of economics, and then maybe hit on your recapture assumptions or what sort of the big assumptions are in getting to that double-digit return profile are?
Well, I think the returns that I alluded to in my conversation were live. I mean, these are literally investments that we made in the last few days. So those we feel like those neighborhood of 10 unlevered returns at multiples just above 3 continue to be available. Now, does everyone hit the 10 mark? I don't know that, Jason. They may be somewhat above, somewhat below. But the key is that these are all on new production loans, right, that have been originated here at nearly the bottom of rate levels of WACs, and also are accompanied by a lower multiple than historical multiples on MSRs. So, I mean, I suspect you may hear people quote MSRs from just, today at new production at just below 10 to, maybe just above 10, and I think that's what we're seeing. You also probably have companies that you cover, familiar with, that have seasoned portfolios that may have multiples closer to 4 or potentially more. And so we think that here at these multiples, we're reasonably comfortable with the speed assumptions. And at the time, for the time being, we're unlevered in that structure. And we do have the ability to lever up to some degree. Although we'll be careful and cautious about that, we do have the ability to lever that up to maintain, a very attractive return profile there.
Great. Thank you.
Thank you. Our next question comes from Christopher Nolan with Ladenburg Thalmann. Please go ahead.
Rock.
Hi, Chris.
Hey, how you guys doing? Rock, what do you think the contribution from that VIE short-term investment will be in the first quarter?
I'll leave that to Rich.
Yeah, Chris, this is Rich. So as you saw in our script and our Q4 investor deck, it contributed about 8 cents for the fourth quarter. And because of the short duration of those assets, these are residential, fix and flip loans that have short maturity, so they pay off quickly. We're expecting it to be significantly paid down, the entire structure by the middle of the year, and it's happening sequentially over that time period. So we don't have it's difficult to predict because it's based upon the underlying performance of the loans in terms of credit quality. It continues to remain strong, but we'll see how that plays out. But our expectation is that it will be somewhere in the in the low single digits in terms of percents per share to core operating income for the first quarter. So we had 8 cents in the fourth quarter, so I expect something much towards the lower single digits in the first quarter. Its contribution to our core operating income.
Great, thank you. And then also in terms of the fix and flip, I mean, that has pretty rich yields in it. Is that something that you guys are actively looking to expand into?
Well, we've made a series of investments there so far, Chris, and we've actually we've built a good deal of intellectual property. We've allied ourselves with a very, very sophisticated partner that we work with in that arena typically. Although we have access to more than one, we've allied so far with one in particular that is extremely sophisticated, and we've been able to build a fair amount of intellectual property around that arena, and so we absolutely would be interested in expanding that in situations where we find that the pricing is acceptable. That's been a little bit tighter lately, alongside other tighter spread investment circumstances, as you well know. But we have come across circumstances even as recently as the last week or two that could be interesting, can form interesting opportunities. So we continue to be focused on that and expect that we will, in fact, have more business purpose loan opportunities and selected mortgage credit opportunities as well, as I said before, that have a bit outsized returns relative to relative to their risks that we see each day in the broader markets.
Great. And final question, Rock, the move into MSRs, and given your comments in terms of concerns about rising prepays, I mean, doesn't the addition of MSRs sort of compound your risk exposure to prepays?
Well, they're really sort of complementary to agencies in a way. Certainly, as to the extent that rates elevate and speeds slow, obviously that's very strong, very a positive factor for MSRs, and we wouldn't be surprised to see potential expansion in multiples as that happens. We've observed, as I'm sure you guys have as well, some expansion in multiple over the last 25 basis point move in rates, and so we wouldn't be surprised if that process can continue as to the extent that rates elevate further. Obviously, so in that way, it sort of complements and naturally complements sort of the agency book. And to the earlier comment, will provide replace and provide some portion of the swap duration hedging effect against the agency portfolio. So they work very nicely together. And I'd say our assumptions are that we're buying in line with market speed assumptions for those assets, or we're assuming higher speeds. So we've sort of tried to protect ourselves a bit on the downside in returns to some extent by sort of raising our speed assessments slightly above market.
Great. Thanks, guys.
Thank you. And Mr. Tonkel, there are no additional questions at this time.
Great. Well, thank you to everyone for your time and your thoughts. And if you have further questions, please don't hesitate to call. Thank you.
Thank you, ladies and gentlemen. This concludes today's conference. You may now disconnect.